In September 2020, JPMorgan Chase agreed to pay $920 million to settle charges of precious metals manipulation. At the time, headlines framed it as punishment. Justice served, case closed, the market moved on. But the price of silver did something far more interesting. It stayed suppressed for years. Not because demand was weak, not because silver lost relevance, but because the structure controlling its price never changed. Behind that settlement sat a deeper contradiction. If JPMorgan was guilty of manipulating silver markets, why did it quietly become the largest known holder of physical silver on Earth afterward? Why did a bank supposedly caught cheating spend the next decade accumulating the very asset it was accused of distorting? That question exposes the lie. The $920 million was not a penalty in the economic sense. It was not a deterrent. It did not dismantle a system. Relative to JPMorgan's balance sheet, it barely registered. Instead, it functioned as a toll, a cost of doing business, a one-time payment that allowed something far more valuable to continue uninterrupted. Price control. For nearly 10 years after the settlement, silver traded in a range that made no sense. Central banks printed trillions. Industrial demand surged. Above-ground inventories declined. Yet silver remained pinned, ignored, dismissed as a relic. The data said one thing, the price said another. That divergence was not accidental. It was engineered. This story is not about conspiracy or secret meetings. It is about market plumbing. About how paper derivatives can overwhelm physical reality, about how a single institution, positioned at the center of the futures market, could suppress price while simultaneously draining supply. And most importantly, it is about why that strategy is now breaking. Because the lie was never that silver was manipulated. That part was admitted, paid for, forgotten. The real lie was that the manipulation ended. It didn't. It evolved. And the consequences of that evolution are only now becoming visible. After the settlement, the narrative was clean and convenient. Regulators had acted. JPMorgan paid the fine. The manipulation was framed as past tense. From a legal perspective, the case was closed. From a market perspective, nothing changed. Silver entered the 2010s under extraordinary macro conditions. Central banks expanded balance sheets at historic speed. Interest rates fell towards zero. Asset prices across equities, real estate, and commodities responded accordingly. Yet silver did not. While gold doubled from its 2015 lows, silver remained trapped below levels reached years earlier. That divergence was striking and persistent. Between 2011 and 2020, silver repeatedly failed to hold rallies above the low $30 range. Each breakout attempt was met with aggressive selling. Price volatility collapsed. Participation dried up. The metal developed a reputation as chronically disappointing, a broken asset in a world of reflation. The market absorbed a simple conclusion. Silver just didn't matter anymore. But that conclusion conflicted with observable reality. Industrial demand did not decline. In fact, it expanded steadily as solar installations, electronics, and advanced manufacturing scaled globally. Mining supply failed to grow in parallel. Above-ground inventories began to thin. None of this showed up in price. The disconnect mattered. In functioning commodity markets, rising demand against constrained supply produces volatility and price discovery. In silver, the opposite occurred. The more the fundamentals tightened, the calmer the price became. That is not a natural outcome. It is a structural one. The reason lies in how silver is priced. Unlike most commodities, silver's price is not set by physical exchange. It is set in futures markets, where contracts representing silver trade in volumes that dwarf the underlying metal. These contracts rarely result in delivery. They settle financially. As long as confidence in settlement remains intact, paper supply can expand without limit. This is where the official story breaks down. The JPMorgan settlement addressed spoofing tactics. It did not challenge the structure that made spoofing effective. The derivatives market remains dominant. Position concentration remained extreme. Price discovery stayed anchored to paper flows rather than physical availability. As a result, suppression did not need to be overt. It became automatic. Every time demand appeared, paper supply met it instantly. Every time sentiment shifted bullish, Futures positioning expanded faster than metal could be withdrawn. The price signal stayed muted, even as the physical signal deteriorated beneath the surface. To outside observers, silver looked irrelevant. To those watching inventories, it looked increasingly scarce. That contradiction persisted for years, and it created the conditions for something more consequential than manipulation. It enabled accumulation. While the market focused on price, the metal itself was quietly moving into fewer hands. The official story said the problem was solved. The data suggested the opposite. And that gap between perception and reality is where the next phase of this market began. The suppression worked because silver stopped being priced as a material. It became priced as a contract. At the center of this shift sits the futures market. On paper, a silver futures contract represents a promise of delivery. In practice, it functions as a financial instrument designed to settle in cash. Delivery is the exception, not the rule. The result is a market where claims on silver can expand independently of the metal itself. This changes everything. In a physical market, supply is constrained by geology, mining timelines, and inventory. In a paper market, supply is constrained only by risk limits and margin requirements. Contracts can be created instantly. Liquidity appears infinite. Price becomes a function of positioning rather than availability. Silver's futures market grew into exactly that structure. By the early 2010s, the volume of paper silver traded daily exceeded annual global mine supply many times over. Open interest routinely represented multiples of all silver held in exchange vaults. Yet the system remained stable because most participants never intended to take delivery. Confidence held it together. This structure created a powerful asymmetry. Institutions with balance sheet capacity could sell paper silver aggressively without sourcing metal. Industrial users and long-term holders, by contrast, required physical supply. The price was set by the former, while the burden fell on the latter. That imbalance favored large banks. JPMorgan entered this landscape with a unique advantage. Through its acquisition of Bear Stearns in 2008, it inherited one of the largest silver derivatives books in the market. What initially appeared to be a liability became strategic insight. The bank now understood the pressure points of the system from the inside. Rather than exit, it adapted. Paper silver allowed price to be capped without exhausting physical reserves. Futures selling could absorb demand surges, flatten volatility, and discourage speculative interest. Over time, this trained the market. Investors learned that silver rallies failed. Capital moved elsewhere. Meanwhile, the physical market told a different story. As paper volumes expanded, the ratio of contracts to deliverable metal widened. Vault inventories declined gradually, then persistently. The system relied on the assumption that delivery requests would remain minimal. As long as that assumption held, price discovery stayed detached from physical reality. This is not a flaw in the system. It is the system. And it explains why regulatory action had limited effect. The settlement addressed tactics, not incentives. The core mechanism, paper dominance over physical price, remained intact. As a result, control did not disappear. It became quieter. For JPMorgan, this environment created optionality. Paper markets suppressed price. Low prices discouraged competition for physical metal. Over time, accumulation became cheaper, not more expensive. The futures market absorbed attention while the real asset changed hands beneath it. This is where misunderstanding sets in. Most observers assume manipulation exists to profit from short-term price moves. In silver, the incentive was longer term. Control price first, accumulate supply second. Let time do the rest. Paper markets made that possible by masking scarcity. But no system based on confidence alone lasts indefinitely. As physical inventories thin and industrial demand hardens, paper promises begin to matter less than metal in hand. When that transition starts, the same structure that once suppressed price becomes a source of instability. And that is when accumulation stops being invisible. Price suppression alone does not explain the last decade of silver. Accumulation does. While silver remained trapped in a narrow trading range, physical metal was quietly migrating into fewer vaults. This shift did not happen suddenly. It unfolded slowly, deliberately, and almost invisibly to anyone focused solely on price. After 2011, JPMorgan's behavior towards silver changed fundamentally. The bank reduced its net exposure to short positions and began increasing its presence in the physical market. Not through public announcements, not through visible hoarding, but through steady absorption of available supply at prices the futures market kept artificially low. This distinction matters. Unlike speculative buying, accumulation does not seek immediate price response. It seeks volume without disturbance. A suppressed market provides exactly that environment. Sellers remain plentiful. Long-term holders grow frustrated. Capital rotates away. Physical metal becomes easier to source, not harder. Over time, this strategy compounds. Exchange data began to reflect the shift. JPMorgan linked vaults grew disproportionately large relative to the rest of the system. In COMEX warehouses, the bank emerged as the dominant custodian of silver bars meeting delivery standards. By the early 2020s, estimates placed JPMorgan in control of a substantial share of all deliverable silver in exchange-approved form. This was not incidental. Deliverable silver is the choke point of the system. It is the bridge between paper claims and physical settlement. Controlling that inventory does not just provide optional upside, it provides leverage over the market stress points. When delivery demand rises, those holding metal gain influence. When inventories tighten, that influence increases. Importantly, this accumulation occurred while silver was widely dismissed. Institutional investors viewed it as volatile and underperforming. Retail interest faded after repeated failed rallies. Media coverage declined. The metal slipped into obscurity. That obscurity was an asset. Low visibility reduces competition. It also reduces political scrutiny. Buying physical silver at scale attracts attention only when price moves. When price stays flat, accumulation looks like storage, not strategy. The regulatory environment reinforced this dynamic. Settlements and fines address conduct, not concentration. No meaningful limits were imposed on physical ownership. As long as futures markets functioned and contracts settled, there was little incentive to intervene. The result was a decade-long transfer. Metal left the open market and entered vaults controlled by institutions with the patience and capital to wait. Above-ground stockpiles declined, but slowly enough to avoid alarm. Each year looked manageable. Collectively, the trend became decisive. This is the critical point. Accumulation does not require belief in an imminent price spike. It requires belief in asymmetry. Downside is limited by production cost and scarcity. Upside is defined by the moment paper claims are tested against physical availability. JPMorgan positioned for that asymmetry. By the mid-2020s, the silver market no longer resembled its early 2010 structure. Supply chains were tighter, industrial demand was structurally higher, exchange inventories were thinner, and a disproportionate share of remaining deliverable metals sat under the control of a single dominant participant. Price had not yet responded. But the balance of power had already shifted. When markets turn, they rarely announce it in advance. They reveal it through positioning. In silver, that positioning was built quietly, over years, while attention was elsewhere. And once accumulation reaches critical mass, the incentive changes. The goal is no longer to keep price low. It is to remain positioned when control gives way to revaluation. That transition is where the next phase begins. Price suppression was not an anomaly. It was a requirement. Silver sits at an uncomfortable intersection of the global economy. It is both a monetary metal and an industrial input. When its price rises too quickly, it sends a signal that policymakers, manufacturers, and financial institutions all prefer to avoid. That signal is scarcity. Over the past decade, silver's industrial role expanded structurally. Solar energy scaled from niche to cornerstone. Each photovoltaic panel requires silver for conductivity. Electric vehicles multiplied that requirement. Advanced electronics, medical applications, and data infrastructure added steady, incremental demand. None of these uses are optional. They are embedded in long-term policy and capital plans. In normal markets, that demand growth would force price discovery. In silver, it did not. Keeping silver cheap served multiple interests simultaneously. Manufacturers benefited from predictable input costs. Governments advancing energy transitions avoided politically inconvenient price spikes. Financial institutions maintained control over a market whose instability could ripple outward. But the most important beneficiary was the futures market itself. Low prices reduced delivery pressure. When silver is cheap and unloved, long holders rarely demand physical settlement. Contracts roll, positions close for cash. The system remains liquid and orderly. High prices, by contrast, change behavior. They attract attention. They invite scrutiny. They encourage holders to question whether paper claims are secure. From that perspective, price stability was a form of risk management. The structure reinforced itself. Suppressed prices discouraged new mining investment. Capital flowed to higher return commodities. Primary silver production stagnated. Recycling remained insufficient to offset consumption. Each year, the physical balance tightened further, even as the paper balance expanded. This created the paradox. Silver became more essential while appearing less valuable. The gap between utility and price widened. That gap could persist only as long as price remained detached from physical reality. Futures markets made that detachment possible by absorbing demand in financial form rather than material form. For JPMorgan and similar institutions, this environment was ideal. Cheap silver meant accumulation could continue without competition. It also meant industrial users stayed complacent, sourcing metal just in time rather than stockpiling. The illusion of abundance held. But illusions have limits. As green energy mandates locked in future demand and supply remained inelastic, silver's role shifted quietly from commodity to constraint. Its low price no longer reflected excess, it reflected delay. The market was borrowing stability from the future. This is why suppression mattered. Not to punish speculators, not to generate trading profits, but to prevent silver from signaling stress elsewhere in the system. A rising silver price would have implied inflationary pressure, supply vulnerability, and monetary fragility. Keeping it contained preserved confidence. It allowed policymakers to proceed as if inputs were secure and money remained credible. Yet confidence built on price control is inherently fragile. When physical demand becomes non-negotiable, paper mechanisms lose effectiveness. Industrial users cannot hedge scarcity indefinitely. At some point, they must secure supply. That is when cheap silver stops being a benefit and starts becoming a risk. The decade-long effort to keep silver inexpensive delayed adjustment. It did not eliminate it. Instead, it concentrated the adjustment into a narrower window. The longer price remained suppressed, the more violent the eventual repricing would need to be. This is the cost of postponement. And as inventories tighten and demand hardens, the conditions that once justified suppression begin to reverse. The same forces that kept silver cheap now make that price unsustainable. What was once a controlled environment is becoming unstable. That instability is where the structure begins to crack. Control systems do not collapse all at once. They fail at the margins first. In silver, those margins began to fray when physical behavior stopped matching paper assumptions. For years, futures markets relied on a simple premise. Most participants would accept cash settlement. Delivery demand would remain manageable. Inventories would fluctuate, but never threaten the system. That premise is now under strain. The earliest signal came from exchange inventories. Registered silver, the metal explicitly available for delivery, began to fall faster than expected. Not in response to a single shock, but through persistent withdrawals. Each drawdown reduced the buffer between paper claims and physical reality. At the same time, lease rates started to move. In normal conditions, borrowing silver is inexpensive. When rates rise sharply, it reflects scarcity, not speculation. It signals that holders are reluctant to part with metal, even temporarily. That reluctance marks a change in mindset. Metal is no longer surplus. It is strategic. Then came backwardation. When spot prices exceed futures prices, the market is offering a premium for immediate delivery over future promises. This reverses the logic of storage and time value. It indicates urgency. Participants are no longer optimizing financially. They are securing supply. These are not abstract indicators. They are mechanical symptoms of stress. Institutional responses confirmed the shift. Reclassifications from registered to eligible silver reduced the amount of metal available for settlement without removing it from vaults. On paper, Inventories remained. In practice, deliverable supply shrank. This preserved optionality for holders while tightening the system. Such moves are defensive. They reflect an environment where control is no longer effortless. Each ounce becomes more valuable as leverage than as liquidity. Holding metal confers influence. Releasing it invites risk. Importantly, these developments did not coincide with panic buying or retail frenzy. They emerged quietly during periods of relative calm. That makes them more significant, not less. Structural cracks appear before narratives catch up. The futures market continues to function. Prices still print. Contracts still trade. But the underlying balance has shifted. The system now depends on confidence that delivery will not be widely requested. Confidence, once lost, is difficult to restore. This is where the dynamic turns. For a decade, price suppression discouraged attention. Now, tightening supply invites it. Each inventory draw raises questions. Each premium reinforces them. Participants begin to notice what price alone obscured. Control does not vanish instantly. It erodes. And erosion changes incentives. When maintaining suppression requires increasingly aggressive intervention, the cost-benefit calculus shifts. The objective is no longer to cap price indefinitely. It is to manage the transition. That transition is visible in positioning. Those who accumulated early can afford volatility. Those relying on paper stability cannot. As stress concentrates, the advantage tilts toward physical holders. The crack is not a headline event. It is a process. And once it begins, the system moves toward a point where price is no longer the primary signal. Availability is. When that happens, control gives way to negotiation, and negotiation gives way to repricing. Silver is approaching that threshold. What follows is not disorder for its own sake. It is adjustment delayed too long, arriving all at once. The endgame was never about a squeeze, it was about positioning. Unlike past silver disruptions, this cycle is not driven by visible speculation or leveraged bets. There are no public champions cornering the market, no concentrated futures longs daring the exchange to respond. That absence is the point. History provides the contrast. In 1980, the Hunt brothers tried to force price discovery through leverage and delivery. They confronted the system directly. The response was swift. Rules changed. Margin requirements surged. Long positions were restricted. The price collapsed. The lesson was not that silver was abundant. It was that challenging the structure head-on was fatal. JPMorgan learned that lesson. Rather than fighting the futures market, it operated within it. Rather than demanding delivery publicly, it absorbed metal quietly. Rather than pushing price higher, it allowed price to remain low long enough for accumulation to reach scale. This approach avoided confrontation and scrutiny. It also avoided leverage. Physical silver carries no margin call, no forced liquidation, no counterparty risk once secured. Time works in favor of the holder. By the mid-2020s, the asymmetry was clear. JPMorgan's exposure was no longer primarily financial. It was strategic. Holding a large share of deliverable silver transformed the bank's role from participant to gatekeeper. In a market dependent on confidence, gatekeepers matter. This reframes the $920 million settlement. Against the estimated value of accumulated silver, the fine looks less like punishment and more like a sunk cost. Spread over a decade, it resembles an entry fee, a one-time expense that cleared legal overhang while leaving structural advantages intact. From this perspective, the manipulation case marked a transition, not a termination. It closed one chapter of overt tactics and opened another of structural control. The objective shifted from managing daily price action to managing long-term optionality. That optionality now defines the endgame. If the market remains orderly, accumulated silver appreciates gradually. If stress escalates, physical holdings confer influence over settlement dynamics. In either scenario, the downside is limited. The upside is asymmetric. This is why there is no urgency to force a crisis. The longer adjustment is delayed, the tighter physical supply becomes. Each year of underinvestment and rising demand increases the value of what is already held. When repricing finally occurs, it will not require orchestration. It will occur because the system runs out of slack. At that point, those with metal are not aggressors. They are liquidity providers on their own terms. This is the quiet power of preparation. The market often imagines endgames as dramatic events. In reality, they are the outcome of positioning done long before attention returns. By the time the narrative shifts, the outcome is largely determined. JPMorgan's strategy reflects that reality. It did not seek to win a public battle. It sought to ensure that, whatever happens next, it stands on the advantage side of scarcity. And when control gives way to repricing, that advantage becomes visible to everyone else. When price control fails, it does not fail politely. It fails through mechanics. The first consequence is not a headline price spike, it is fragmentation. Futures prices continue to trade, but physical premiums detach. Availability replaces price as the dominant signal. The market stops asking how much silver costs and starts asking whether it can be sourced at all. This is where paper credibility erodes. Futures markets rely on the assumption that settlement is optional. When participants begin to prefer delivery over cash, that assumption collapses. Exchanges respond defensively, margin requirements rise, position limits tighten, delivery rules become more restrictive. These actions are framed as stability measures, but they reveal stress. At that point, price becomes secondary. Industrial users cannot substitute paper for metal. Solar manufacturers, electronics firms, defense contractors, and infrastructure suppliers require physical inputs. When supply tightens, they pay premiums. When premiums rise, they stockpile. That behavior accelerates the drain on available inventory. Feedback loops form quickly. As physical supply disappears, futures prices lose their anchoring function. Arbitrage fails because metal cannot be sourced to complete the trade. The paper market continues to quote prices that no longer reflect transaction reality. A two-tier market emerges, one financial, one physical. This is the moment when the lie becomes visible. For years, silver was priced as if abundance existed. When that assumption breaks, repricing is not gradual. It is discontinuous. Markets move not to equilibrium, but to ration demand. Price rises until behavior changes, until some buyers step away. Historically, this phase produces volatility that looks irrational. In reality, it is overdue. The system is compressing years of adjustment into months. Participants who relied on stability scramble. Those who prepared simply wait. The broader implications extend beyond silver. A breakdown in silver pricing challenges confidence in derivatives as a proxy for reality. It exposes how financial instruments can mask scarcity until it becomes unavoidable. That lesson does not remain confined to one metal. It travels across commodities and into currency markets. Silver has always been a signal, not because of its size, but because of its dual role. When monetary trust weakens and industrial demand hardens simultaneously, silver reflects both stresses at once. That convergence is rare. When it occurs, it forces repricing not just of metal, but of assumptions. This is why the end of suppression matters. Not because prices go higher, but because they stop being managed. When control breaks, markets rediscover constraints they had ignored. Scarcity reasserts itself. Time compresses. Those holding paper promises learn what they actually own. Those holding physical assets learn why they waited. The lie was never sustainable. It was only postponable. And now, the cost of postponement is coming due. The settlement closed a case. It did not close the system. For more than a decade, silver prices told a story of irrelevance. Cheap, abundant, forgettable. That story was convenient. It supported industrial expansion, financial stability, and the illusion that scarcity could be managed indefinitely through paper. But beneath the surface, the opposite was happening. Physical silver was consolidating. Inventories were thinning. Demand was hardening into necessity, and control quietly shifted from the market to those who understood its weakest point, deliverable metal. The $920 million fine now looks different in that light. It was not the end of manipulation, it was the price of transition. From overt tactics to structural dominance, from short-term price games to long-term positioning. This is why the breakdown matters. When the lie breaks, it will not break as a scandal. It will break as a shortage. Not everyone will notice at once. Prices may still trade, screens will still update, but access will narrow, premiums will widen, delivery will become conditional. That is how truth re-enters financial markets. through friction. Silver is not collapsing a system, it is revealing one. It shows what happens when confidence substitutes for inventory and when time is used to postpone adjustment instead of preparing for it. In the end, this is not a story about JPMorgan alone. It is a story about incentives, about how markets reward patience over noise, about how scarcity reasserts itself after long suppression. The real cost of the lie is not measured in fines. It is measured in how violently reality returns once denial is exhausted. And that return has already begun.